Okay, hello and good morning. My name is Paul Sanfilippo here at Penny Insurance Center. I'm a marketing director here, and today we're very excited to have you guys out of a part of this five-part series on kind of demystifying the Index Universal Life product that's out there in the space. We're very excited to have North American as a partner to kind of present this educational series over the next 5 weeks, so we're excited to have you here. We'll be recording our webinar today so that we will have an opportunity to kind of review some of the information that we cover on this topic over the course of the upcoming weeks, and that'll be hosted on the pennyinsurance.com website, and we'll get everybody that's on the call today sort of a link once we have it out up there. And our goal is really to start building out the information center on IUL, especially premiering companies like North American that we've chosen to definitely partner with and premiere as one of the go-to carriers in the space, because they have things like product breadth that I feel is very important when you start looking at these products and introducing these opportunities to your clients out in the marketplace. Chris Korfe is here with us today. He's an internal wholesaler with North American that's going to kind of take us through this process. And if you have any questions that you want to pose to Chris during out the call, there is a questions box part of the go-to meeting. Please push your questions through, and if we have a chance to pause the presentation throughout the process and address those questions, we will, but we're going to keep the lines open at the end to kind of discuss some of this from a Q&A standpoint. So without any delay, I'd like to turn this over to Chris.
I want to thank everyone that took the time today to be on this webinar. As Paul had mentioned, this is a five-part series, so this is the first of the five. We're going to be covering it's called IUL Mechanics. And just a quick background, we designed this five-part series about 2 years ago because we saw the need that there was a lot of, I don't want to say confusion, but not a lot of knowledge on how Index Universal Life works. So really what we hope and want to get out of this five-part series is to break these products down on a granular level so that not only you as an agent understand it better, but so you can explain it to your client better and why it's a good fit for their needs. So with that, we'll get going here. Of course, compliance has their say. So our agenda on this webinar today, it's going to be a quick-hitting 15, 20-minute webinar, a lot of information, so we don't want to drag it out, so you forget a lot of what is said today. So we're going to be covering indexed and fixed account options, crediting methods, segments and buckets, annual resets and floor rates, participation and cap rates, and our minimum alternate account value. So on our indexed and fixed account options, we have multiple index choices, depending on the product, up to 13. New premiums can go into any index. You can move between choices or to the fixed account at the end of any index segment. On the fixed account, we do not require any money to be allocated into our fixed account. Some carriers do. We do not. And you can move from the fixed account to the indexed account on any trading day. So you can move back and forth very easily. Some of the crediting methods we have, if you are familiar with index annuities, index IUL, it's the standard ones. Your annual point-to-points, your monthly point-to-points, your daily averaging, and we also have a multi-index annual point-to-point. So we're going to start today by looking at our annual point-to-point. This is the one we use for our illustrated rate. We take our current cap of 13.5%, geometrically backtested 30 years, and we have a current rate of 8.2 as our maximum illustrated rate. And that's using the S&P 500 annual point-to-point. So how is this calculated? Well, basically, you take your ending index value and subtract it from your beginning index value, and you divide it by that beginning index value. You apply the participation rate, apply any cap and floor rates, apply an interest rate bonus if that applies, and then you multiply the result by the indexed account value. So we're going to take a look at an example here of an annual point-to-point. So let's say our beginning index option value is $1,500, and our account index value is $10,000. Assuming a 13% cap and a 100% participation rate with a zero floor, meaning if it goes negative, it's going to be zero, and we have a 0.75% interest rate bonus. So here are 3 examples of how this would be calculated. Let's say that the index here finished at 2,200. So you take the ending index, 2,200, subtract out the beginning, which is 15, and divide that by 1,500, which you get a 46.67% return. The cap is 13% plus the 7.75% interest rate bonus means that we're going to credit the account 13.75% that year. If you take a look at the second example, it only went up 100 points, so take your 1,600, subtract out the 1,500, divide that by the 15, and you get a return of 6.67%. Adding in the interest rate bonus, you now have 7.42 for a return. And the last example, the market went down. Well, as I stated before, with the 0% floor, we're not going to charge a negative, so the return was 0. With the interest rate bonus, that's a 0.75% return. Your client will still show a positive number. This is very similar to our builder IUL. Right now that cap is 13.5%, and you get that 0.75% interest rate bonus after the 11th year. So that's kind of what we're showing here. And then in the bottom bullet, it just shows in real dollars, what does that mean? That 10,000 then goes to 11,375 in the first example, 10,742, and then 10,075 in the last example. And like I said, this is our annual point-to-point. It's what we base our projective off of. This is what I consider to be kind of your safest approach as far as an indexing option. We're just looking at what is the index at today and what's it at a year from now. It doesn't really concern us how volatile it is in between. We're just looking at those 2 numbers. So the next one we're going to look at is our monthly point-to-point option. Very similar to the annual point-to-point, we're just doing it monthly instead of annually. So instead of 2 points, we're looking at basically 13. So you take your ending monthly index value, subtract the beginning monthly index value, and you divide it by the beginning. You apply the monthly cap rate, do that for all 12 months, apply the participation rate and floor rate, apply an interest rate bonus if that applies, and then you multiply the result by the index value. So here's an example of that. Now I know there's a lot of numbers on here, but just kind of want to walk you through how this goes. So in this example, let's say that our beginning index value is 900 and our monthly cap rate is 4%. As before, we have a 100% par rate, no floor, and a set 0.75% interest rate bonus, and we're going to start with the same $10,000. So you can see the first month, the index went from 900 to 925. Then in the next month, it went from 925 to 940, then down to 930, up to 960, and so on and so forth throughout the year. So by doing our math in step 2, we see that with the returns, we had a 2.78, a 1.62, a negative 106, 3.23, 3.13, negative 6.57, 5.95, and so on and so forth. I want to draw your attention to a couple things here. So as you can see there in the 6th month, we had a negative 6.57. In the month after, we had a positive 5.95. Stands to reason. If you have a big dip, it's easier to get it back. So if you go down to step 3, you'll now see that we did a negative 6.57, but the next month we did a 4. Well, you capped out on that 7th month. The return was higher than the 4%, so that's all you're getting. On the bottom side, there is no cap. So basically what you do is in step 3, you add up all your positives, subtract all your negatives, and that's what you get. In this case, we had a positive 5.68. We add in the 0.75 interest rate bonus to get a net effective yield of 6.43, which But you're saying, hey, wait a second, Chris, I thought you said there wouldn't be a negative. Well, what would happen would be if we did the step 3 and added up the positives, subtracted out the negatives, and that equaled a negative number, then it would be the 0. So we're not going to go back, but while we're figuring out the calculation, we will, so like I said, subtract out the negatives, add up the positives. So, as you can, probably figure out, this would be an option you want to use if you think you were going to have a true bull market. If we had a true bull market where each month was up 4% or more, we would credit 48% to the policy. But obviously, if you're in a volatile situation, since you're not capped on the downside, but you are on the upside, maybe the market could end up returning. Let's say that one month it's up 6, and then the next month it's down 4, and then up 6 and down 4. Well, at the end of that 12 months, it's going to be up 12%, but you're going to show a 0 because you're not capped on the downside, but you are on the top side. So, all these index options, the nice thing is you can have more than one in the policy. You can diversify within the policy. Just want to know how each one works. And like I said, this one, definitely you eat some of that volatility. So the next one that we have is the daily averaging. This is, kind of if you want a real linear, kind of vanilla, how's it going to return this year, this would kind of be your one. And we don't see this one used as much as the other two, but it is still used. And basically how this works is you take your average index value, which is the sum of each business day's values divided by the number of business days. You subtract out your beginning annual index value and divide by the beginning annual index value. As the other ones, you apply your participation rates, apply the floor rates, apply the interest rate bonus that applies, and the multiple the result by the index value. So let's just take a look at an example of that. So let's say our beginning index option value was 1,500, and our average index option value was 1,650. Basically what we did is we took all the trading days ending values, added them together, divided them by the number of trading days there were. Now in a daily averaging, a lot of times you'll have no cap and a higher than average participation rate. So here we have no cap and a participation rate of 102.5%. And then we have the interest rate bonus of 0.75%. Using the $10,000 again, you do the math there of your step 1. You take the 1,650, subtract out the 1,500, and you get 10%. Then you want to multiply it by the 102.5, and then you add in your bonus of 0.75%. So that's how the daily averaging works. Like I said, that one gets used more for if you just want to really you want to smooth out those highs, but you're also going to raise up the lows, just kind of smooth everything out. That's how the daily averaging works. So when do we see this option used? We see this option used more if the market did go down, but there is some volatility, and the participation rate is maybe at 110% or things of that nature. When you see those higher par rates, that's when a lot of times people will gravitate more to the daily average option. And then lastly, we're going to cover our multi-index annual point-to-point. So an annual point-to-point, much like the first one we went over, like the S&P, we're going to look at 2 points and go from there. But here we're using 3 different options. And we use the S&P 500, the Euro Stoxx 50, and the Russell 2000. So basically what we're going to do is just like in the first one, the annual point-to-point, we're going to look at the S&P 500, when the starting date is, when the ending date is, was there a gain or not? We'll do the math. Same for the Euro Stoxx 50. Same for the Russell 2000. Then what we're going to do is we're going to combine the 3 performance results, and we're going to give whichever one performed the best, the S&P, the Euro Stoxx, or the Russell, 50%. And the second best one is going to get 30, and then the one after that is going to get 20%. Apply the participation rate if it applies, caps and floors, interest rate bonus, and then multiply the result. So we're going to take look at an example of that. let's say that our S&P 500 had a starting value of 1025 with a cap of 13.5. The Russell 2000, say, was at 975 with a cap of 10.5, and the Euro Stoxx 50 started at 2570, had a cap of 12.5. So now we're going to look at our ending index values. S&P, that was up. Great. Russell was down, as was the Euro Stoxx. So what we do is we do our calculations. There's a 19.51 return on the S&P, and we had negative returns on the other two. So what we do is we do 50% of 19.51 at 50%, do the 30% on the other one of the negative, and then we do 20% of the biggest negative. And much like the annual point-to-point, we will subtract out, add up the positives, subtract out the negatives. We get a 6.03% return. And since the cap is 13.5, obviously we hit the 6.03. Add in the interest rate bonus, and we get 6.78. I know there's a lot of numbers here and a lot of moving parts, but the nice thing is with this particular index that you can choose, not only are you with the 13 different index options, like I said, you can really diversify within the product for your client, but here you're getting into other accounts. You have the Russell, you have the Euro Stoxx. So within the product and within this, just index itself, you're diversified. And that's really attractive to some clients that like that diversification. So each segment has an annual reset feature. This means that once the bucket reaches its one-year duration, it will calculate the index growth using the crediting method selected. Then we apply the participation rate, cap, floor rates for that crediting method. The result will be credited to the account value of the IUL policy, and then once the bucket is dumped to the account, it will start the next duration. So if you, say, are paying monthly premiums, that first year will have 12 different buckets. What's nice about that is you get more diversification within the product itself because you have different start dates, different end dates. The market's always moving every day. So instead of just keeping it all into one, bucket where you could have a just disastrous, say, 1 month to wipe it all out, you're going to be diversified within depending on when that money goes in. So here's what we're showing here by our annual reset with the 0% floor. So once again, the 0% floor just means that it will never show a negative number on there. And annual reset means that, if the market, say, let's just use the S&P, if it's at 1,500 and you have a down year, like this particular example, it's down 10%, so it goes down 150. Well, now you're starting at 1,350 the next year. A 10% gain is only 135 points instead of 150 is when we first started. So, yes, we never like to see a down market because that means you're not getting a return that year. But if you have a year where the market really crashes, you're starting at that lower level, making it easier to get the gains in the next couple of years. So that's what's nice. So you can see here with the annual reset and 0% floor versus no reset, our beginning value is 100. It's down 10% the first year. So with no reset, you're down to 90. With the floor and the annual, you're still at 100. Get a 12% gain, so you're at 112 in the annual reset, and you're at about 101 on the other one. Goes down again, we just plateau, and then it goes up 14%. You can see the difference there, what it makes to have that annual reset and the floor. So here we're showing difference of participation rates and caps. So the dark green slide is just showing the index, just whatever index it is that we're doing. Then we're showing in the light green no cap but a 65% participation rate, and then the gray we're showing an annual cap of 12%. So they all begin at 100. After a 10% fall in the index, both the participation rate and cap rate have 0, so they remain at 100. Obviously, the index, drops 15%. The next year shows a 14% underlying index growth. With a 65% participation rate, that grows by 9.1%. So no cap, but we're only giving you 65% of what the index does. So that goes to 109.1. The cap rate gets 12 of the 14. So that goes up to, or I should say gets 12 of the 14, so that goes up to 112. The following year shows just a modest growth of 4%. So the 65% par rate gets 2.6, and of course the cap rate gets the full 4. The final year shows a big jump of 25%. So the 65 participation rate cap gets credited 16.25 that year, while the cap rate hits its limit of 12, so it just gets the 12. Of course, the index gets the full 25. Of course, this isn't a real index performance or a real product, but just hope this helps understand how participation and cap rates work. Once again, so if when you're doing those annual reviews with your clients, if we're just coming out of a year like say 2008 where the market just really tanked, you can take advantage of some of these situations by going maybe with a participation rate at 65% or whatever it is at that current time, because history shows that once you come down, it goes up pretty quick. Well, if the market goes up, like you say here, 25%, you can get 16.5 on that. So it's all just knowing how these moving parts work to better help your clients get more value in their product. Next and last thing I want to talk about here is our minimum account value. So this is a separate bookkeeping entry we have. We continually check when it lapses or at surrenders, and it's an 8-year true-up, and it does not have a reset. But basically what we're saying is after 8 years, we're going to take a look at your policy, and if it hasn't averaged at least 3% return, we're going to true it up and do that for you. So here's a graph how that would look. So the light green is showing our side account of the minimum account value, and the dark green is showing the actual account value. So you can see in year 1, the market was down, so there was no return. You can see in year 2, there was some modest growth. Year 3, it was flat again. And then we had some years of some growth, and then the final year, 7 to 8, there was no growth. So if this was your policy, what we would do is we would take a look at it and say, okay, well, we're at about 142 in actual account value. The minimum account value would be at right around 128, so we don't have to adjust anything. Now, if that dark green line was under the light green line, then we go back, true it up, put you at the 128, and that's where you would start. So that is how that particular function works on that product. So that was the last thing I had to go over as far as the presentation today. Here is our contact information here at North American, our sales development line. That's our general sales support assistance line. They can help you with, if you have website issues, running illustrations, things of that nature. You can see our hours here at 7:30 to 5 Central, and then we're out of here at 12:30 on Fridays. And my contact information is there on the bottom. It's just my initials, my first and last name, ckorfe at sfgmembers.com. There's my extension, so you can just dial that 800-800-3656. My extension is 36326. And of course, you can always contact the helpful people over at Penny, and they can also assist you. So with that, I would gladly take any questions that might have come up.
We have a question that came in, and one of the questions are, how does North American charge for the no lapse guarantee option in the product? So maybe what we can just maybe focus on is that in today's call we were kind of going over the mechanics of how the index are built. I believe on the upcoming calls we're going to start dissecting some of the products. I mean, obviously cost of insurance is always associated with any product, so when the dollars come into the account, cost of of having the product is typically subtracted out, and then your investment dollars are subject to the performance of the index like any other product. And we'll start looking at, in more depth of how these different products are built, where the costs are associated, and sometimes, you're sacrificing costs for guarantees, which in some people's minds make them feel very comfortable to give up a little to have more security in the long term. Well, another question is when was this type of product first introduced into the market, and what was the average returns that have been realized over the life of the product?
Our product came out, we're just starting to hit that 8 years, so we are starting to go through our policies now and seeing if that true-up needs to happen. I don't have I saw a graph here or some information a few months ago, and I believe the average for that 7-8 year period return was around I think 7.5%. When our products first came out, our caps were right around 14.5%, or 14% to start, and then when we, a few years ago, switched our loan, and we'll get into the loans, like I said, later down the road, but since we're talking about cap rates, when we switched our product to have the variable loan with the capped at 6, then we lowered all new business by 0.5 point. But really, in the 7 years, our caps have varied from as low as 12 to as high as 14 over the entire 7-year period. So we don't really mess around too much with the caps on the annual point-to-point.
One other thing that we can contest here at Penny Insurance to address some of John's questions is, there's probably a full decade of time that the Index Universal Life product has kind of been out in the space. American General was probably one of the first carriers from an innovation perspective to bring this product out, and the big focus was really for the affluent and the premium finance world, and it's evolved over time, and where there was probably just a handful of carriers that represented this product in the marketplace. Just in the last 18 months, almost every carrier you could imagine has an Index Universal Life product to participate in the space because of the rapid growth and attraction from a consumer perspective to be involved. But what we've done at Penny Insurance is we are able to run Monte Carlo results on all of our participating carriers' products, and we typically look at the 100% guarantee return. So, on these month-to-month and year-to-year buckets, looking back over 40 or 50 years, we can show across the board what carriers, and based on their participation rates and their caps and their floors, where are the more leading products that are in the space, and North American definitely ranks in the top percentiles from a performance perspective. So what we can do and what we do on an ongoing basis, there's always two components to this. Is one, can we get you underwritten at the classification that's acceptable to the client and as well as at the carrier, and two, what is the true performance expectation that we can anticipate, and we're able to extract that data out and use realized numbers so that when you're sitting in front of a client, you're illustrating one of North American's products at 7.2%, that will be the 100% back-tested number based on that time, and to have a real true underlying investment return versus just a subjective hypothetical number that's used across the board, whether it's 3% or 5% or 6% or whatever you feel comfortable with. So what we try to do for our agents is really positioning your products and the performance to truly be, what it has done in the past, even though it's not indicative of future results. And let's see, we got a couple of questions still here. Will long-term riders be discussed as part of this product in the upcoming webinar?
Yes.
Yes, we will. And then what type of questions should we ask our clients to determine what funds we should place them in? And I think in the last part of this series, we're going to kind of discuss the how to sell, which will really start to engage in how to position. But in a short fall, it's our job as agents and advisors to help our clients kind of navigate what best options are. And you can tell through risk tolerance questionnaires and conversations that you have with clients, what is probably the more appropriate asset allocation strategy or index strategy you want to start out with. And over time, as clients' risk tolerance begin to sort of expand, as well as what market indications are, we help sort of advise clients on how to diversify the index portfolios inside of their products. So, in short, for the simple-minded individual that doesn't like a lot of moving parts, an S&P 500 and an annual point-to-point would be a very easy way for a client to kind of get involved and take advantage of the upside potential. And then as the sophistication level of the client grows, you start to look, within the product and start diversifying amongst buckets to take advantage of what's going on in the marketplace and potentially, more mature upsides throughout the calendar year. And hopefully that answers your question. All right, and I think at this time we don't have any more questions, so I definitely appreciate everybody coming out. Like I said, this is a 5-part series that we discussed, and we'll re-air this webinar back up on our site here in the next 24 to 48 hours to give you some access to get back. I just want to let you all know that we have some individuals on our side at Penny Insurance that will be reaching out to help expand maybe some questions that you've had from the webinar or may come up over the next day or two, and our goal is just to help bring this product more to light for you as a tangible opportunity for you to start sharing with your clients and your consumers in the marketplace. We want to thank Chris for coming out and being part of the call, and we appreciate everybody taking some time out of their day to spend some time and learn more about IUL. You guys have a great day out there, and we look forward to talking to you all soon.